Well, the buoyancy in markets, which we saw early today morning, seems to have fizzled out a bit. We did clock an intraday high of 25,873, so we tested 25,900 in fact, but we've come straight off. We're currently sitting very, very close to the day's lows, around 20 odd points from the day's lows. 25,679 is where we currently sit at, or rather 25,682 is where we sit at, just about 20 odd points from the day's lows. In terms of the Nifty 50 pack, first off, with regard to the breadth on the Nifty 50, well, about 30 declines to 20 advances. So that's where there's a bit of delta. Let's look at a few stocks which are obviously reeling under pressure. 3% lower on an Eternal. Cipla down 2.5%+. BL, Hindalco, Geofin, it's a mixed bag. But all of those stocks are down 2.5%+ in trade as we speak. So you're seeing some pressure across those counters. And HDFC Life came out with numbers down over 1.5% in trade. ITC continues to be under pressure, 1.3% lower even today. 330 is the kind of level that's currently being tested on an ITC. When you're looking at contributors though, what's standing out? And Infosys contributing 65 positive points. HDFC Bank, contributing 21 points, and Tech Mahindra contributing 11 points. So that's where the tilt is. Private sector banks to some extent, and then you have the IT stocks, Infi and Tech Mahindra. Even an SBI is doing fairly well for itself. So you've got, that's basically the tilt of the market. Despite that, ICICI Bank still in the red. So that's the play at this point. Let me first go across to Rabinder, who now joins us to tell us all of the stocks that are buzzing in trade on the back of corporate announcements. Rabinder, your list.
Well, yes, Infosys is in focus on the back of the strong Q3 FY26 number, and the management has also increased their FY26 guidance. In Q3 FY26, company revenue saw an uptick of 2.2% quarter-on-quarter basis in constant currency term, but PAT saw a decline on the back of the one-time labor code change. And for FY26 now, management say that they are expecting a CC revenue growth of 3 to 3.5% as compared to earlier guidance of 2 to 3%, and EBIT margins guidance maintained at 20 to 22%, and deal win was steady in the Q3 FY26. And after that, the brokerages has come out with a note, and they have increased their target price. So back of this strong set of number and bullish report from the brokerages, Infosys is in focus, and the stock is top gainers of the Nifty 50 index. Apart from this, another IT stock, LTI Mindtree, is also in focus on the back of their order win, where company has win order of rupees 3,000 crore of 7-year contract from Central Board of Direct Taxation Insight 2.0 AI Tax Analytics project. So back of this order win, LTI Mindtree is also in focus, and the stock is up more than 4%. Federal Bank is also in focus on the back of their quarterly earnings, where in Q3 FY26 company net profit saw an uptick of approximately 9% year-on-year basis. And if we talk about banks NII, then NII saw an uptick of 9% year-on-year basis at 2,652 crore, and company's asset quality has also improved on a sequential basis. Angel One is also in focus on the back of their strong Q3 FY26 earning, where company's revenue saw an uptick of 5.8% year-on-year basis, and client funding book also saw a good uptick of more than 10% year-on-year basis, and board has also approved a stock split of 1:10. So back of this news flow and earnings, strong Q3 FY26 earning, Indian One is also in focus. Grow, another stock buzzing on the back of their strong earnings, where companies net profits saw an uptick of 16% on a sequential basis, and net revenue also saw an uptick of approximately 19.5% on a quarter-on-quarter basis. And apart from this, State Street has also announced an investment in Grow AMC, and State Street will invest 580 crore in the Grow AMC for the 23% stake. So back of this, Grow is also in focus, and Cipla is also in under pressure on the back of the news flow, where company has announced temporary supply pause for one of its drug following US FDA audit of the partner facility, and this drug has a 22% market share in the US. So after that, Nuama has come out with a note, and they have downgraded the stock to reduce and cut target price to rupees 1,360 as compared to earlier target price rupees 1,750. They say that the near-term earning visibility weakened due to temporary production pause pause at European CMO Pharma 10. So back of this, supply is under pressure. Ahluwalia contract is in focus on the back of the order when company has one order of rupees 3070 crore from the Central Public Work Department, New Delhi. And lastly, Zentech is also in focus on the back of the order when company has received order of rupees approximately 404 crore from the Ministry of Defence. So back of this order win, Zentech is also in focus.
Thank you so much for that, Rabinder. Those are all of the stocks that you want to keep on your radar because they're buzzing in trade today. The Nifty mid-cap and small-cap indices, well, there's a bit of divergence coming in there. 30% low on the Nifty small-cap index. The Nifty mid-cap index holding fort. It's holding in the green, largely in line with the large-cap index. It's the Nifty IT index which is really standing out in trade today. 3% move, 1,200 points on the Nifty IT index, doing very well for itself. On a day like this. The Nifty Bank around 0.8% higher. We're holding above the 60,000 mark where the Nifty Bank index is concerned as well. So both of those in tandem still not able to aid the Nifty 50 index. Is that a surprise, Kunal?
It's a big surprise. If you ask me, I think that 180 point advantage which we had for the index was quite a strong advantage. But then again, I think we've tapped back into a resistance point for the Nifty. In the last 5 days, we've tested this range of 25,900-ish on the spot levels, I think 3 times. And all 3 days were intraday or crucial days for the indices, where the expectation was that maybe the markets would probably want to surpass about this 25,900 kind of a zone. And if that happens, we could be looking at a breakout. But then the selling pressure is rising back again at those higher levels. So that's a concern for the index. And this tells you that this resistance levels would generally be taken out only on the back of some event or trigger for the markets. Devoid of that, I think we may have into multiple attempts for the index to break past about those levels, but it will be futile attempts for the markets.
Well, Kunal, at what point can we comfortably say that Nifty can hold above 26K? Because we arrived at that point at some point of time a couple of weeks back, but we've quickly, very, very quickly given away with any hope of hitting and breaching 26K sustainably.
Well, yes, absolutely, Harsh. And I think one of the reasons for that, of course, is the major drop in the larger cap names. The list of large cap stocks which have fallen down. I think that's the concern for the markets. And we've been making this point over the last 4-5 days also, that till the time the weight of those large cap stocks which have fallen, that continues to drag the index on an overall basis, and you need some strong outperforming stocks to offset this kind of a loss, not just to try and balance the index out, but to try and ensure that the index goes into a turnaround. So as of now, we've just seen the works coming by from the likes of Infosys, for example, which has done reasonably well. So very few large cap stocks which are just about trying to balance the kind of losses the larger cap stocks have shown in the last couple of weeks. That's one of the reasons why the index has been unable to surpass those levels of 25,900 mark. Now, the question is what could trigger the index about those higher levels? That I believe could probably be in terms of events, recovery from large cap names like Reliance, maybe HDFC Bank, because these are two strong stocks, not just in terms of the weightage, but in terms of the sentiments also for the overall markets. And maybe I think if there is a fresh sector participation which comes by, because right now we are just dependent on the likes of banks, IT and metals, which have been doing the heavyweight. Most of the other sectors, pharma, FMCG, etc., these stocks and sectors have gone through a drag and into a corrective phase further. So that's dragging the index on the lower side. So you need strong bit of outperformance from the ones which have been doing very well, as well as strong bit of covering up of the underperformance from the larger cap names like Reliance, HDFC Bank.
Okay, let's talk a little bit more about Infosys. In fact, it's the top gainer on the Nifty today after the company raised its FY26 guidance, even though profit was hit due to a one-time labor cost change impact. Analysts remain bullish though. The company says their deal pipeline remains healthy. Listen in to what they have to say.
On the demand, we see a good demand outlook in the sense of we have had strong large deals. Our large deals pipeline remains healthy. And we are seeing in the two industries that I mentioned on financial services, on an energy resources, utility services, a way that our work on AI is going, and the way the deals have shaped up, we see a good outlook as we look even beyond this financial year into the next financial year. On financial services specifically, we see discretionary spend and good traction in what we are seeing across the market. Having said that, overall, we want to still see all of the other industries and segments start to show that, but these two are definitely something that we are seeing today.
Okay, and L&T Tech, in fact, that company as well has reported a mixed Q3 FY26. We spoke with Amit Chadha, who is the Managing Director and CEO at L&T Tech Services, over the future outlook and what to expect. Listen in.
If you look at it, we've grown at about 10% plus year on year. And that's been led, if I may, by sustainability, which grew double digit year on year yet again. Second, we saw some improvement in mobility trends, and tech, of course, has grown 5.5%. So that's been broadly as you've seen it. North America actually grew 15% plus year on year. Europe came in about 2% up year on year. So that's broadly been the contours of where we've been this quarter. Not just that, I would like to add that we've actually improved our EBIT margins to 14.6%, up 120 bips. And our gross margin is up 200 bips as we speak right now. We are pivoting to trying to become the first EI, engineering intelligence company headquartered in India. And it's a first. There is nobody else in this space. We do believe that we are about 9 to 12 months ahead of competition in this area. EI for us means bringing physical, industrial, digital, all of it together to deliver solutions for our clients' products and processes. So as we look ahead, you can definitely look at growth, and you can look at growth as well as profits, both of them improving as we look forward.
Okay, what we'll do is dive straight into a break. On the other side, we'll have a special conversation with regard to the budget. And of course, we'll have Kunal's picks as well. So stay with us. Back, and we're of course with Kunal. Kunal, your picks for this afternoon?
Yeah, so I'll go with a couple of buy calls. My expectation is that there are a few mid-cap names which are doing fairly well for themselves. Central Bank is one of them. The stock confirming a classical breakout. It's a swing pattern breakout. It's a breakout above its 200-day moving average for Central Bank. So looks attractive for a near-term target of 44. Stop loss could be kept at 36 mark. The second is about Varun Beverages. It's quite an excellent chart because on the short to medium term basis, the stock had broken past above its 200-day moving average, I think a couple of weeks back. But since then, the stock has been holding on to this level of 200 DMA even after a phase of correction for the overall markets. And that, I believe, could be a very strong signal that we might probably expect the stock to go into a strong recovery mode. So we'll look at a buy on Varun Beverages, targets of 520, stop loss at 488.
Okay, so Varun Beverages on Kunal's radar, but let's go across. Special conversation with regard to the budget, and in the run-up to the budget, we have Manish Agarwal, partner at Deloitte India, joining us this afternoon. Manish, great having you. Let me set the context first off. By the way, viewers, this is a larger conversation with regard to infrastructure and what spend we can expect from the budget and what changes should happen at a ground level to ensure that the spend that India is making actually lands up transmitting the way one wants to in the most efficient fashion. Okay, Manish, let me start off. Talk to us about the biggest gaps you see today between policy intent and actual private capital participation.
I would say that, look, the policy intent has been great. From intent to execution, there has been a lot of a movement, I would say. Having said that, I mean, I still see the private sector participation could have been much higher, which I believe is not to the extent of some of the areas that I highlighted. For example, I mean, you have still delays in terms of your claims, your settlement of some of these dues from the various government departments, some of the issues on the regulatory side, which takes a long time to close out. So on the ground, you see that from a private sector investment standpoint, if you have some of these delays in some of the project related issues and the concession related issues, I think that gives a little bit of a lesser comfort for me to keep spending more. That's one. Second, I think the government has done a great job in opening up many avenues for capital raise. So whether it is InvITs, whether it is capital markets or beyond, we have a private credit. For example, they recently allowed acquisition financing for M&A, which has been a great step, and we have been talking about this for last many years. So I think a lot of policy announcements which are very positive. I think I would like to see that some of these get off the ground very quickly. So, for example, acquisition financing, how fast some of the top banks in India start doing that is, to my mind, my ask would be that there's a great intent, great policy announcements. How do we fast get them to the market?
Manish, roads and highways continue to dominate, especially where asset monetization is concerned. How can the government replicate this success in, say, for example, some of the other sectors, railways, power, and the like?
Absolutely true, and that's why I said that my second ask when you asked me about from expectation of a budget on a national monetization pipeline. My ask is that my expectation this time is that if you see the two sectors which has got the maximum traction within infrastructure from a capital standpoint and the asset monetization standpoint is roads and renewables. I would really want to see this traction on the transmission, on the railways, on the gas pipelines, on some of these logistics, for example. It's a pool of capital waiting and very high interest from some of the corridors, including Middle East and Japan, where our Prime Minister went. And there's a lot of intent there from investing into these sectors. Airports, it's a little bit of a sad that we have been talking about airport monetization and the privatization for a long period of time. The clusters of the airports, we are still waiting. So I think there are many sectors where I believe there is a long-term pool of capital which is waiting to happen. We can get a very, very competitive pricing as well. And I expect that if there is an announcement around the national monetization pipeline, some of these sectors, which has been a little bit of a sluggish in the first round, should get a more traction.
And Manish, with the 30,000 crore asset monetization target for FY26 likely to be met, what should be the next phase of monetization focus?
Look, I would expect that, any monetization pipeline that you're talking, and we are talking of, let's say, about 4 to 5 years, at least it will be, every year we can have at least a 50,000 odd crores. So 5 years, about 3 to 5 lakhs crore over the 4 years period can be a very, very good numbers to my mind, and the scale and the size. And mind you, we are talking of multiple sectors within infra. Infra is not just one sector. So we can do it in roads, airports, logistics, real estate, stadiums we talked about, gas pipelines we talked about. So there are multiple sectors, transmission we talked about. So I think from a number standpoint, I think that there's a huge pipe. I am expecting a large pipe to come in if the announcement were to be made. I feel that some of the sectors should get more traction than some sectors which are already on an autopilot basis. Even if the government does something or not, power and renewables will keep, renewables and roads will keep getting that momentum. And I think one thing I would like to see is that this monetization is also about not just InvITs. It is beyond that as well, so that there's a private sector participation in bringing efficiencies, in bringing technology. See, I think one thing we have to remember in infrastructure, especially whether it is digital or whether it's physical infrastructure, I think a lot of a technological embedding we can do to make it more efficient. And I think that is where the private sector efficiencies come in, which can only happen if it is a non-InvIT kind of a structure. So I think a mix of both. Yes, sure, InvIT is a very good product. There's a demand for that, but we should also do the other side of a PPPs as well.
You also mentioned InvITs. How critical is a clear framework for at least mergers of InvITs? How important or material is that? And could Budget 2026 be that turning point?
I think so. I think just to step back, look at from a standpoint that so far over the last 3-4 years since when this entire product came to the market, and we have seen a lot of InvITs coming up. So the government has done a great job, to be honest with you, to get so many InvITs off the ground. So we are at a stage where the consolidation is one of the themes, where we are looking at different sectors kind of an InvIT we can play together. I can give you one example, which is a small but an important anomaly, is that, so for example, distribution is in the list of infrastructure projects where we can do an InvIT. The focus on the distribution by the government, and rightly so, the smart meter project and the program that the government has launched, it is very extremely important because ultimately it goes towards making distribution a very robust sector, reducing the losses, for example, increasing the cash flows to the utility. However, today I think there is an ambiguity in terms of whether can I do an InvIT for a smart meter. So I think if we can have some of these consolidation sort of a theme, some of these ambiguities that can get clarified, I think that will go a very, very long turning point to my mind to get more of these capital and the big ticket sizes to the sector.
And Manish, if you had to just pick one reform in Budget 2026 that could unlock the next wave of infra investments, what would that be?
I think I would really like to see urban infrastructure. If you ask me one thing which I'm very close, it may not be the boldest, but at least I feel that with all the movement towards the cities, all the movements and the things that the government has done to make aspirational districts, this entire urbanization thing, the industrial clusters we are talking about, here there's a lot of capital which can come in, long-term capital can come in, water, wastewater, industrial water, sewage. I mean, these are very, very important sectors, and we have seen some of the events folding around us that how important these are, and why can't we have a long-term capital coming into that? And therefore, I think the way the government did, I can give you a parallel why I'm very passionate about urban infrastructure. It's a very large sector. We have hardly seen very meaningful investments going into the sector. Like what government did when they took over 2014-15, the renewable, we are talking today of renewable as a baseline, roads as a baseline. But what changed the game? The game was changed when actually you got SECI into it, you got NVVN into it, your scale and size of the project changed, the counterparty risk you dealt with better in the structuring, and therefore we need same kind of a structure. You have a roads because of NHI, and therefore you need something like that to really have in an urban infrastructure a lot of a capital to come in. At a center, probably it is still something that moves. At a states, there is a lot of these potential to raise resources without compromising the fiscal discipline. I think there need to be an institutional structure to create confidence and the comfort in the pool of capital that can go towards states and urban infrastructure as well. So that is what my one topmost thing will be, which I would like to see in the budget.
Manish, thank you so much for coming in and speaking with us. This has been extremely productive. Also, viewers, very quickly, I want to highlight some flashes at the bottom of your screen. That seems to suggest that the government will lift the cap on foreign investment in domestic defense firms. Currently, that lid or that cap is 49%. The government plans to ease that further, 74%, which will pave the way for foreign investment in Indian defense firms. And you can see the spike on the Nifty India Defense Index as a result of that. Of course, we will talk about this and more, but what we'll do is slip into a very short break. We'll continue conversation on the other side.
Well, all about earnings. That's how it's turning out to be. You've got Reliance Industries coming out with its numbers later today, post-market hours. And then, of course, over the weekend, that's tomorrow, you'll have the big boys from the private banking world. That's HDFC Bank and ICICI Bank delivering their numbers. But let's first start off with Reliance. And we've got Shesha here to tell us what to expect from Reliance today.
Well, yes, big boy Reliance Industries is all set to report its numbers, and we are expecting sequential as well as year-on-year growth this time around. Consolidated revenue this time is expected to come in at about 2,58,330 odd crores, which will be an increase of about 1% on a sequential basis and 8% on a year-on-year basis. EBITDA margins, meanwhile, are also expected to expand. We are expecting EBITDA margins for Reliance Industries to come in at 18.5% versus 18% that the company had reported in the second quarter, which is an increase of about 50 basis points on a sequential basis. Let's talk about the segment-wise performance then. First up, Reliance Retail, where we are expecting 10% revenue growth and about 5% growth on the EBITDA level. Now remember, higher footfalls on account of GST-led rate cut are likely to aid numbers for Reliance Retail this time around. Margins are expected to contract for Reliance Retail on account of RCPL demerger and rising quick commerce resilience that we have seen in the quarter gone by. As far as oils to chemical and O2C, that is an oil and gas business is concerned, O2C EBITDA is expected to see a jump of about 10% on a sequential basis. Remember, we are expecting good set of numbers from the oil to chemical business on account of higher refining margins. As far as gross refining margins are concerned, they are expected to come in at about $12 per barrel versus $8 to $10 per barrel GRMs that the company has been reporting for the last 6 quarters. Oil and gas EBITDA, meanwhile, could see a marginal decline on a sequential basis. Telecom business, that one is also expected to report strong set. We are expecting 2.5 to 3% revenue growth and about a 2.8 to 3% EBITDA growth this time around. Average revenue per user could come in at about 213 to 214 rupees per user per month, which will be an increase of a marginal 1% on a sequential basis. But any kind of management commentary around new businesses, around telecom price hike, especially before Reliance Jio listing, will be very crucial this time around. But yes, Reliance Jio is expected to report strong set, and on a consolidated level too, Reliance is expected to report strong set of numbers, both growth on a sequential as well as on a year-on-year basis.
Thank you so much for that, Ashesha. Let's also listen in to what ICICI Securities Probal Sen had to say over his expectations from Reliance.
Q3 of FY25 had a very strong base. From levels of 5,500 crore, the EBITDA went to 6,800 crore from Q2 FY25 to Q3. And that would have probably impacted the base and therefore the YY numbers. But even on a QOQ level, the growth is that we are penciling in is closer to about 4%. So that is, slightly more moderate than what the numbers have been for the last couple of quarters. Geo, again, while YY growth is significant, on a QOQ basis, it's basically between 2 to 2.5%. And OTC, I think, while it is going to be fairly strong, maybe the concerns are that that strength may not hold too much in the next quarter. So to that extent, I think probably the market would be looking at guidance in terms of outlook on each of these segments and developments on the new energy front. And I think those would be the critical to sort of drive the stock performance forward. Plus, of course, whatever milestones are being hit in new energy and further news flow around Geo's listing. If any sort of update is given by the management, those will be, I think, looked forward to.
In fact, let's welcome on board Devin Choksi and ask him what he's expecting from Reliance. Devin, hi, good afternoon. Years of tracking Reliance. What do we expect this quarter, though?
Yeah, good afternoon, Aisha. Well, I think the couple of important points. I think this quarter could be, the quarter, where probably we'll see both industrial products as well as the consumer product segments showing up, significantly better performance. Largely the fact that they have been having the advantage of lower crude price as far as intake is concerned should get reflected into the refining and the petrochemical products revenue stream particularly. And that's what one is basically expecting to see, higher amount of contribution. Currently, they are about 55-56% of the total profit picture, comes out of the industrial products. And around 40-45%, comes out of the consumer-facing products as a total EBITDA pool of the company. In my viewpoint, this time around, there is a very strong possibility that you're going to see slightly better contribution coming from the industrial segment vis-a-vis the consumer segment per se. because the size of the pool is increasing and the profit margins are going to be better in that area of activity. The retail business, in a way, I think if you look at the FMCG part of the retail business, which has now become the subsidiary of Reliance Industries, is basically growing at a faster pace. Last year about 11,000 crore. This year expected to be somewhere around 20,000 crore. March 26 is going to be the pace at which I think the retail business, FMCG business particularly, is growing. And overall pool of, I think, the retail distribution business in the retail particularly is happening because of the GST cut and a higher amount of availability of funds in the hands of consumer. So overall, I think the growth in the volume terms as well as I think in the business overall, I think is going to grow very smartly. The one point which you will probably, I think, and all of us are looking at is geo platforms, which is basically coming up with an IPO by the middle of this calendar year. In my viewpoint, I think Geo platform is the one I think which is going to be the driver of the profit picture as well as the stock. Believe that I think about 65,000 odd crore kind of an EBITDA making machine in Geo platform could possibly grow at a compounded rate of growth of around 15 to 20% in a larger format in which they are entering, including some global expansion that they are talking about. So overall, both consumer-facing businesses as well as industrial business, I think both of them are likely to show better performance in the third quarter of the financial year.
Okay. Devin, there's also banks, right? And some of the PSU banks have come out with a very decent set of numbers. Today we had a central bank come out. We also spoke with the Union Bank of India. Again, more than a decent set that some of these banks are delivering. Do you believe that that's where the lower hanging fruit within the financials is? Where is it that risk reward looks most compelling to you?
Harsh, I think the important part out here would be that yes, I think some of the public sector banks and among them I think smaller banks also, they are putting it a valuation which is far more cheaper compared to I think their peers in the mid-tier and the larger segment is concerned, both in NBFC as well as in the bank is concerned. When I look at I think one important differentiator here, of course I think the advantage is that lower interest cost regime helps in form of bringing down the liability related cost, unless I think the banks have not been able to manage the asset liability part I think in a systematic manner. But overall, as a direction, I think they are in a better position to bring down the liability side of the cost. Importantly, I think the acceleration, as I see it in the business for stronger NBFC and the stronger private sector bank, would be the integration of the fintech platform in extending the loans to the end customer in a systematic and sustainable manner is going to be the key drivers. For example, Bajaj Finance kind of companies, they are growing between the 22 to 25% CAGR kind of a loan growth. Even their housing finance company also grows in the same fashion, I think around 22%, 23% kind of a growth, loan book growth. Whereas I think the industry players are growing in single digit or maybe slightly higher to a double digit. In my viewpoint, I think the biggest differentiator for them is I think the adoption of fintech at the front in distributing the loan. So our eyes remain absolutely focused. They're one who grows systematically, keeping minimum amount of non-performing assets into the book, and at the same time, higher amount of growth rate in tech. I think that they are producing due to use of the technology is something which we like the most. Of course, liability side management, as I said before, the blessings that interest costs have come down. So obviously, I think you're managing it a little better than what you used to manage last year, for example.
Okay. Devin, the other piece that I'd be keen to know is IT, because that's the other big mover. Again, you're seeing a bit of a divergence, and L&T Tech, the numbers were softer, at least on the top line. Market's super disappointed with regard to that. But then you have Infosys, which has hiked its guidance. Do you believe that there as well, that the risk reward looks most compelling within large cap versus mid, small ER&D? Where are you placed within that basket?
Undoubtedly the large caps, largely because of the fact that I think they are probably putting it a valuation where the downside is minimum. The mid-size IT companies have been probably putting it a valuation where probably I think the chances of mistakes are not allowed in the marketplace, or lower expectation growth or lower than expected growth is not allowed in the marketplace. So Infosys, TCS, HCL Tech results have given that kind of indication very clearly. One, in the quarterly order intake rates, I think the order book position that they have created in most of the verticals, I think have been far more better than probably the market was a little nervous about. So that is one good point which has happened. Second thing, even if you normalize the profit after deducting that labor cost related thing which has affected all of them, I think at least the worst part is getting booked into the quarter, and I think the next quarter starts with a relatively fresher kind of a outlook. So, in my viewpoint, the large cap companies are having two bigger advantage also along with. One, their clientele size is big, obviously, and as a result of which, I think they're in a better position to win the larger part of contracts. That is the first point. Second, the coding part of the activity through the use of AI, I think has systematically started helping them in delivering the solution faster to the client. And third, likes of TCS have demonstrated that they would like to go for capital intensive business model in form of data center as well. So which is giving them, I think, good amount of product related sustainability related growth, I think, in coming times. So in my viewpoint, I think it makes sense to stay with, I think, the larger ones. Their downside risk, I think, remains limited in this kind of situation.
Devin, great to have you on the show today. Thank you so much for your time.
Thank you. Thank you so much.
Okay, on that note, let's take a very quick break. We're mildly in the green right now. Let's see how the last lap of trading pans out.
Welcome back. Of course, we have Kunal with us. Joining us also is Rajesh Palvia, who's technical analyst at Axis Securities, joining us this afternoon. Rajesh, talk to us about how you're viewing markets. It's another day of trade where we've given up pretty much all the gains. The resistance is sharp. I'm trying to get a sense on how you're viewing it and when does the tide turn?
So good afternoon, Harsh. So it's a choppy market. Looking at the Nifty behavior, 25,900 is acting as a major supply zone for the Nifty. And again, in today's pullback action also, Nifty, witness a supply from those level. Call writers are confident around 25,900, 26,000 level. There is no as such unwinding has been witnessed despite we have seen pullback in first half of the trade. So the major supply zone 25,900 until the Nifty not crosses this level, we may see a range bound activity in range of like 25,700 is the immediate support area for the Nifty, and on the higher side 25,900. I think we could see the trading in this range only for Nifty, but Bank Nifty is showing sign of strength, and here one can see more traction on the buying side as Bank Nifty manages to cross major call concentration area of 60,000 and sustaining above those level. So I think if it continues to trade above 60,000 mark, I think we could see another 300, 400 point up move in Bank Nifty. Here we could see more, opportunity on the long side of trade. So those who wants to play on index, they can play in Bank Nifty with stop loss of 59,800, upside target 60,200 to 60,400. We could see next 1 or 2 trading session.
Let's switch focus. Largest private sector lender, HDFC Bank, also the largest constituent on the Nifty 50 index, all set to announce its third quarter numbers. Street expects another steady performance with improved margins. My colleague Mitali joins us with what we can expect from an HDFC Bank.
For HDFC Bank, the street is estimating a steady performance for Q3 FY26 with 3% quarter-on-quarter growth seen in advances and deposits, and also the loan momentum similar as of Q2. Margins are likely to improve sequentially with NIMs seen at around 3.39%, supported by better deposit repricing. If you talk about their cost ratios, they're expected to remain stable with OPEX growth in low single digits. Asset quality is seen stable, though some seasonal stress due to the KCC and agri loans may emerge. Credit costs are also expected to remain constrained. Profit is projected to grow in low double digits year-on-year basis, despite being largely flat on a quarterly basis. Key monitorables for the company's results include management commentary on the margin trajectory and also the exit NIMs, loan versus deposit growth balance, outlook on the retail and unsecured lending, mortgage growth strategy, and also signals on the capital usage and FY27 growth.
Right. And Mithali, what's the expectation from ICICI Bank?
So we have ICICI banks declaring their results tomorrow, and the street is estimating a steady performance for Q3 FY26 on the back of stable margins, controlled costs, and healthy asset quality. The net interest income, it is expected to grow on the back of consistent loan expansion and stable yields. While if you talk about their margins, they're expected to be in the range bound 4 to 4.5%, broadly flat on a sequential basis, as lower funding costs offset the pressure on the asset yields. On the bottom line, the profit after tax, it is projected largely flat sequentially, but you might see an increase on an yearly basis, an increase of around 4.7%, reflecting stable core earnings and also benign credit costs. Also, the asset quality trends, they remain encouraging. Looking ahead, the loan and deposits growth, it is expected to be around 3.5% and 3.8% respectively, with digital platforms gaining traction. Additionally, the credit costs, they are expected to stay under control, while the implementation of the expected credit loss norms, it is actually going to have a positive large impact on the company's earnings visibility and also the strengthening balance sheet. So overall, ICICI Bank's Q3 performance is expected to reflect stability, resilience, and also disciplined execution.
Okay, thank you so much for that, Mithali. Rajat Sharma, founder and CEO at Sana Securities, joining us this afternoon as well. Rajat, we've seen a decent pullback when it comes to an HDFC Bank. We've also seen some bit of an underperformance when it comes to ICICI Bank. Good time to nibble on just prior to the numbers. Is that something, or is that a segment of BFSI which you're looking at actively, and you think that there's value there?
Yes, no, just before the numbers would actually be a good time to buy into this. Now, based on the kind of numbers we've seen from financial services in general and banking stocks in particular, yesterday IOB reported very good numbers. Union Bank reported pretty much subdued numbers. HDB Financial reported very, very good numbers. So it's been a very, stock specific good or bad numbers, if you may. But I think HDFC Bank in particular, as it is, if you just forget about the fact that it's due to report numbers, is right now trading at very attractive valuations. It's the largest bank, it's got a great price to book. I mean, if you look at the metrics, it's a bank available at very, very cheap valuations, and one of the best franchise in India to own. And given where it's trading, I would think that if the numbers are anywhat better than subdued, if the way everyone's projecting it to be, then this stock could jump up quite nicely from here. Also, keep in mind that personally, I'm optimistic that in this budget there would be some relief in terms of taxation, whether it's long-term tax, just to attract FIIs back into the country. And HDFC Bank is, the favorite stock for FIIs. Traditionally, if you look at it, that's where they've had the highest allocation. So no matter how you look at it, it's very, very well positioned. Both HDFC Bank and ICICI Financials is a sector where, we're looking to add right now.
Interesting. Rajat, what about Reliance Industries, though? Looks like a value buy right now, but do you think earnings can actually justify that, if indeed it were a buy at these levels for you?
Yeah, Aisha, I have to give a disclosure. I don't have Reliance Industries. I don't track this stock very closely because, I personally feel this is a stock which will always keep moving in line with the overall markets. Nothing beyond that, nothing under that. They've got so many diversified businesses that I stopped looking at it really.
Okay, Kunal, let me come to you with regard to a technical check with regard to HDFC and ICICI. What's the take there?
Yeah, we've seen a good recovery for HDFC Bank. The stock recovering from those 925 kind of a zone. 960 still remains to be a breakout point for HDFC Bank. Hopefully, post results, if the price action is on the positive side, we might expect that the stock actually shows that kind of a breakout, which has been due and pending for quite some time for HDFC Bank. For Reliance Industries, that breakout point is around the 1490, 1500 zone. This was the previous swing resistance for the stock price on the daily chart. So we need to see these breakouts being taken out for the stocks to come back into a strong recovery phase.
Look at the breakout on Federal Bank though today, 8.5% higher. Rajesh, what's the reading on the charts for either a Federal Bank or any of the PSBs for that matter?
So Federal Bank has managed to give breakout of its previous swing high, and now stock is back to all-time high trajectory. Looking at the today's move, especially very strong volume action, and now stock is showing a sign of strength. Despite so much of run up in today's session, I think if stocks manages to surpass again 272 level, I think upward trajectory around 285 to 290 we could see in near term perspective. So buy and accumulate would be the strategy. On the downside, 262 needs to keep as a stop loss for Federal Bank. Again, if I go with the public sector bank, I think Bank of India is showing sign of strength, and the way a stock is moving in series of higher top, higher bottom formation, I think here we could see more traction towards 165, 170 zones. So Bank of India is also looking attractive. On the downside, 154 needs to keep as a stop loss.
Okay. All right. What about Reliance, Rajesh?
So Reliance is now trading around its 100-day moving average. If I go with the put-based concentration, 1450 has attracted a major put writing activity. Looking at the near-term structure, stock is poised for giving some pullback action from the current level, as from the lower level 1450 acted as a good support area in past also. So risk to reward is in favor to play some pullback trade here. So I think one can keep a stop loss towards 1425 if you're buying here in Reliance Industry, or you can play with some call option buying. You can buy around 1450 call option, which is trading at around 34 rupees. Keep your stop loss at around 20 rupees, and we believe that some pullback action can be there in this counter, and possible target towards 65 to 70 we can see for call option.
Interesting. That's the day coming in on Reliance on charts. We'll take a very quick break on that note, come back and continue our discussion with our experts. Good.
Well, yes, all eyes are going to be on Tech Mahindra, because along with Wipro, it's going to be coming out with its numbers later today. So let's understand what the street is largely penciling in. On a sequential consolidated basis, revenue is expected to come in at 14,168 crores, which is absolutely flat, an uptick of about 1 to 1.5% on a sequential basis. EBIT is expected to grow up by about 4.5 to 5% sequentially. It's the net profit number that we are going to be watching out for very closely. Lots of positive factors here. We're expecting to see a jump of 14.5% here on a sequential basis. So this is going to be important to watch out for. And EBIT margins are expected to also see a slight uptick at 12.6% compared to 12.1% in the previous quarter. Also largely what we're expecting to see, the constant currency revenue growth is seen at just 0.5%, led by retail and the Comviva business. And net new deal wins are expected to range between 875 to 900 million US dollars, which is up 10% on a sequential basis and 20% on a year-on-year basis. Let's understand some more expectations. Revenue growth is expected to be led by the retail and the Comviva businesses. EBIT margin expansion is expected to be led by operating efficiencies, and the rupee depreciation should also aid the margins. New deals are likely to have higher margins than the existing ones, so that is another key positive for Tech Mahindra. And strong verticals are expected to be BFSI, retail, logistics, transport and healthcare this time around. On the flip side, we're expecting to see some weakness in the affected verticals like high-tech, manufacturing and telecom. So when the numbers do come out later today, watch out for the impact of the labor cost charges that we have seen impacting other IT companies, the momentum that they have in the consulting and Gen AI segment, their deal pipeline, conversion timelines and some pickup if expected in the deal pipeline when it comes to Europe, revenue leakage in existing accounts, telecom segment demand outlook, and any outlook on the 5G technology, the TCV deal wins, and any update on capital allocation policy. All of these are going to be important metrics to watch out for when it comes to Tech Mahindra. But yes, overall, we're expecting a very decent show in Q3 from Tech Mahindra.
Right, Rajat, wanting to understand where within IT, if at all, are your biases and preferences?
So I had two stocks that we've added. One is, a stock where I had a fairly large holding, which was added before the results, was Infosys, because, as I said, the two platforms with which they're working, Nia and Topaz, I looked at this around 2-3 months back and talked about it. They're going to implement AI use for their customers and clients, particularly in manufacturing and financials at a mass scale. And we've seen this before, whether it was cloud a few years back, then digital, and now implementation of AI. Indian IT always lags behind, the US, where a lot of this high-end developments happen, and Indian IT then implements it at a mass scale. The valuations at which IT sector is trading right now are not cheap compared to the last 10-year averages, but they're in line. The Nifty IT index in all is around 25, and right now it's trading at 26, so it's slightly more, 5-7% more expensive than its average. Be that as it may, that's primarily because the sales, the total revenue has not increased for the last few years. But with the positive guidance that we saw from Infosys, keep in mind it's not so positive. They've just increased their guidance from 1 to 2% to 3 to 5%. Compare this with 16-17% growth in earnings kind of guidance, which they used to have until a few years back. But the sentiment is changing, and they're really undervalued, these stocks. So that's first stock where we've added more. The other one is a mid-cap IT stock, which is Birlasoft, because they're again at a forefront of implementing artificial intelligence and training the staff of their customers on how to use AI. It's a platform called Skillshare that they have. And as it gets close to the $1 billion mark in revenue, Birlasoft, I think there would be a re-rating on the cards for that. So these are the two IT stocks which we've added. I will also give you a disclosure. IT remains right now my favorite sector because, I believe in value investing, and I believe in holding stocks for multi-year, not like my long term is not 3-4 years, it's 5-7 years. And IT is a core sector. It will eventually bounce back.
Okay. Rajat, also keen to understand your views on defense, because this FII, the FII cap, which will likely be moved upwards from 49% to 74%, does that materially change the way one looks at defense? Because this will mean foreign participation in a far larger fashion in Indian companies, and therefore the Make in India agenda will see a lift, and this at a time when we're very close to the budget as well. So all of it, how are you looking at defense, and how does this kind of change the thesis, if at all it does?
No, as I just said, I don't find value in this sector. Most of the stocks you look at are trading at such extreme valuations that, despite the recent correction that we've had, they'd already run up so much in price that I think a lot more correction needs to happen. Yes, the world seems like an unsafe place, and, a lot more money is being pushed into defense companies, particularly in India. But I've really not spotted anything in the listed space where it's the same names: Mazagon Dock, Bharat Electronics, and BHEL, and Tejas Networks. A lot of these companies are trading at such extreme valuations that when I look at them, no matter what kind of growth I factor into them for the next few years, yes, if there is an increase in the FII cap, these stocks might just show a knee-jerk reaction, go up 5-7%, but will eventually cool down and come down to they have to be at the right price for someone to buy these.
Right, you got Polycab's numbers, the consolidated profit of 622 odd crore rupees, and that's an uptick of about almost 36% that one has seen, because the comparable mark was about almost 458 odd crore rupees in the same quarter last year. Kunal, Polycab, RR Cable, these have gone through a fair share of correction all through last year. Now a buy, what would you say about these names?
Yeah, indicator-wise, these stocks are coming to an oversold territory, and a deep oversold territory as such. When I look at it on the daily, weekly time frame, I think are hitting back towards the major oversold points, even though the prices have not reached the previous supports. For example, Polycab, the recent low for the stock in the month of December was around the 7,000, 7,050 mark. Currently, the stock is at 7,200 plus levels, which means it still has that cushion of 200 points from the previous swing lows. However, the RSIs, the indicators on a relative basis have hit back to that oversold territory, which it did in the month of December. So I think in that sense, maybe I think this could be a point where the prices are going through an odd phase of a correction, and the indicators are showing signs of bottoming out. And if this reversal happens, I think now we could be looking at these stocks trying to challenge back even their previous major highs. So the risk reward is favorable to go for a buy purely because the indicators are into a oversold territory, and maybe keeping a stop loss of 7,000, traders could look at a contra on Polycab.
Wow, okay, Polycab, the PAT numbers largely in line with expectations, and therefore that's something that maybe you want to consider. No movement on the stock, or rather not much movement on the stock. Now let's switch focus though for just a minute before we come back. Okay, so there's you can see the margin number 12.5% odd versus the 13.8% YOY number. I'll await the EBITDA number, which was expected at around 920 odd crore for Polycab. So we'll wait for that particular number, but that's probably the crucial number which I'd want to know as to where that sits. Just wait for a couple of seconds. If that number were to come, there you go, 967. So EBITDA has come in ahead of estimates. That seems to be what it is. There's something between that EBITDA line and the profitability line which seems to have hurt the numbers to some extent. Margins have come off as well, so EBITDA margins haven't come in line either. So maybe it's a mixed bag of numbers is how we'll read through it. Profit largely in line with expectations or estimates. Now let's switch focus. SEBI has released a consultation paper on netting of funds for FPIs in cash market transactions. Ankur here with all of the details.
Yes, SEBI has issued a consultation paper in which there is a proposal that FPIs will be allowed netting of funds in cash market. What does it mean? Till now, the gross settlement was there, whereby there was a lot of liquidity pressure. Suppose 100 crore shares you have bought and 100 crore you have sold. So the net amount you have to pay now. However, the settlement of shares will happen like it was happening before. There is no change in STT also, that has been clarified, but all will depend on the final rules which will come out from SEBI. But for now, netting to be permitted only for outright buy or outright sell transactions, and intraday buy and sell in the same securities to continue on gross settlement basis, and there is no change which is proposed by SEBI on that front. But all in all, SEBI has clearly invited public comments on this issue till February 6, but it may give a release to FPIs.
Okay, SEBI is now aiming to cut the liquidity pressure on FPIs. Remember, all through last year, our equity markets, of course, have grappled with the FPI, FI exodus. Let's see whether these tweaks actually help bring those flows back or not. Counting down to the market close, and we're closing it pretty quiet. I think, Kunal, this has been one of the narrowest trading ranges that we've seen, at least this week or in the last fortnight.
Yeah, I think so. Almost 200 points. It's been the trading range for the index today.
Yeah, so that's that. While of course today the winners are Infosys all the way, 5.25% of a move is what Infy is going to close the day with. Techem also a solid 5% move coming in there. Wipro ahead of its numbers, 3% higher. HCL Technologies, TCS, these are all your top 5 movers. Look at SBI, that's been a very, very strong show. A solid 1.25% move is what we've seen for SBI as well. Tata Consumer, Tata Motors Passenger Vehicles, HDFC Bank ahead of its numbers. These have all been the gainers. Absolutely flat for Reliance Industries ahead of its numbers later today. Mildly soft for L&T, Eicher as well a little bit soft, and then NTPC, etc. Some of the gainers of this past week, Coal India, etc., have also seen some bit of an ease off. Look at the volatility on an Eternal. It's down 4%, and I don't know if we can bring up the, this week chart for Eternal or not. It's had some very, very huge and wild swings. I mean, on days it's gone down 4% and gone up 4% as well. Rajesh, what are you making of the price action on Eternal?
So for this week, it's a choppy week for the Eternal. But if we analyze last 3-4 week price behavior, it's in range itself. Stock not able to surpass its 295-300 supply area, which is very important and critical for the stock. Though looking at the near-term behavior, stock is having good support area at around 280-275 zone, which is very important for this correction. So I think the selling pressure is absorbed around those levels. So I think if it continues to trade about 280-85 mark, I think some buying interest would remain in this counter around these level. any breakout about 295 can take stock further higher to 310. So I think after a correction now, consolidation is happening in range. And we believe that, that stock has, potential to give breakout on the higher side. So 295, one needs to watch closely. If breakout happens, then one can add more positions.
Okay, so that's with regard to an eternal. Kunal, do you have a view with regard to this one?
Yeah, I think over the last 1 week, the stock has seen almost like a 8 to 9% recovery from 274 thereabouts to 295, 300, where the stock tested on Wednesday, and today it's coming back into a kind of a corrective phase. So it's come back to the midpoint of this 25 odd point range for eternal. 275 still seems to be a strong support over the stock price. However, I think today's volume being on the much higher side as compared to the volumes in the previous days when the stock had done quite okay for itself. So that indicates that this could be maybe a fresh round of selling which could have happened to the stock price. So not initiating a buy, but I think maybe this time around if the stock drifts down to that 274 mark, there could be a second attempt where the stock may try and go into a bounce back mode.
Okay, that's with regard to eternal. So the IT counters, Rajesh, I'm curious to know, Tech Mahindra in particular, that's one of those IT counters which are absolutely flying in trade, 5% higher. How is this one looking on charts?
Very strong setup for Tech Mahindra, and stock now managed to give breakout of its previous swing high of December also. And looking at the short-term structure, we believe that until stock is trading above 1640, 1650 mark, I think we could see further higher trajectory towards 1730. That's the next target where we are focusing on this counter. So those who are already bought stock at lower level can trail stop loss at 1630 to hold the position for 1720, 1730 kind of target in the continuation of this up move.
Okay, all right. Wipro on charts, Kunal, very quickly.
See, it looks attractive, and given the fact that the stock has seen almost like a 20% recovery from 220 levels, which was the low for Wipro in the month of September, October, towards the point when the stock had recently moved towards the 270, 275 zone. So this seems to be a very strong recovery which has come back for Wipro, and price-wise also, even on relative strength-wise, it's come back towards the top 3, top 4 performing large-cap IT names, and it's also exceeded the likes of TCS, for example, in that context. So I would believe Wipro could be a decent chart to look out for. The supports for the stock in the near term is still around the 255 mark, which also coincides with the 50-day moving average for Wipro.
In fact, let me take it across to Snehi and understand what the ET Now poll is factoring in for Wipro as well.
Well, yes, some more IT earnings to watch out for from the big names. You have Wipro that's going to be coming out with its numbers, and we're expecting a largely very flat quarter for Wipro this time around. On a consolidated year-on-year basis, revenue is expected to go up by just 3.2% sequentially at 23,428 crores. EBIT is expected to be up about 4% on a sequential basis, but PAT is where we are seeing some pressure on account of the labor cost charges that we've seen. This has impacted other names like TCS and Infosys also. So we'll watch out for what the impact is over here. But yes, we're expecting to see about a 3% downtick on the net profit in a sequential basis. EBITDA margins are expected to remain absolutely flat at 16.7% on a sequential basis. Here are some key expectations then. The residual ramp up of the Phoenix mega deal and the recent deal wins should aid the top line growth for Wipro this time around. IT services EBIT is expected to dip. They expect order intake, especially for large deals, to remain healthy given ongoing aggression in large deals pursuits by Wipro. So this could be another factor that could be important to watch out for. And the residual ramp up of the Phoenix mega deal, like we spoke to you about, is going to be a catalyst one to watch out for. So when the numbers do come out, watch out for demand trends in affected verticals like retail, energy and manufacturing. And on the flip side, what is the growth in some high growth verticals like BFSI, pricing stress in large contracts and the resulting margin impact, strength of the large deal pipeline and conversion rates, and pace of Gen AI adoption. And of course, the impact that other IT companies have seen on the back of this one-time labor cost charge. So we'll be watching out for what that impact is over there. The constant currency growth, the impact of the H-1B visas, all of that is going to be very key to watch out for. So keep a close eye for Wipro.
Okay, that's about Wipro, and it's really all about IT as we wind down on the week today. Other than that, Rajat, where from within the earnings season this time around are you anticipating any positive surprises, if at all?
Yeah, I'm happy you asked me that, Aisha, because the space that I'm really looking out for is actually a very boring space for most people, consumption, and within consumption, FMCG. Look, the reason is FMCG stocks had been struggling on account of a lot of competition from unregulated players because the GST was implemented a few years back, which was really high. Now with GST down to 5% and almost zero GST on a lot of items, there's a lot of stocks which have fallen in terms of value. Even if you look at the top two stocks of the FMCG index, HUL was reporting a revenue of something like 39,000 crore, the top line around 5 years back. Today, that has jumped up to something like 64,000 crore. Yet, the stock price is 2,300. 5 years back, it's 2,300 today. It's not moved at all. The same time, the valuations for the stock 5 years back it used to trade at 65, 66 kind of trailing price to earning. It's now down to 44. So any improvement in earnings there, any growth in volume in this part should take, the stock price higher, because I don't think it's going to fall any more from here. Purely if you look at the 10, 20, 30-year kind of valuation. Same problem with ITC. Of course, ITC is right now being hit by a major hike in the tobacco taxation. Be that as it may, the other problem which ITC also has is that the revenue from FMCG non-cigarette is not translating into the profit, into net profit. So they get about 25 to 26% from non-cigarette FMCG. So FMCG sector, I'm looking forward to, the earnings, because this is now onwards where you'll see the real impact of, GST cuts being felt. A lot of these unregulated players, which were giving them intense competition, and also online commerce. Now, HUL and some of these bigger companies have got into that space and creating their own digital presence. So this is a space to watch out for. Also, again, because the valuations more than IT, it's actually the valuations in the FMCG sector, which nobody believes has cooled down. Look at the 10-year multiple and look at the current multiple. You'll see that it's all trading 20 to 25% below. So that's a space where I'm looking out to, watch out for earnings there.
All right. Okay. Rajat, Rajesh, thank you so much. We'll let you go on that note. It's another very, very flat day for markets. Maybe a slight positive.